Hey everyone, and welcome back. And you know I love a good deep dive, and today we're taking on a real classic, The Intelligent Investor by Benjamin Graham.
Ooh, yeah, that's a good one.
Yeah, so first published in 1949, and it's considered like the foundation, the Bible of value investing. So
Absolutely.
we're going to be talking all about that today, and hopefully by the end you'll walk away feeling like a more intelligent investor.
That sounds good.
So to kick things off,
Yeah.
when we hear that title, The Intelligent Investor, what does Graham actually mean by that? Is it just like having a high IQ or something?
No, no, not at all. He actually emphasizes qualities that anyone can develop. Things like patience and discipline, having a thirst for knowledge.
I like that thirst for knowledge.
Yeah, like constantly learning and being willing to put in the time to research and analyze.
So it's not just like, following the latest trends or listening to those hot stock tips you hear everywhere.
Yeah, exactly. It's much more about being methodical and analytical, really thinking like a detective, carefully examining the evidence before making any moves.
Interesting. So like a financial detective.
Precisely.
Now, Graham makes this really important distinction between investment and speculation. And I'll admit I sometimes struggle with this.
Yeah, it's a fine line sometime.
It is. So how does Graham define those two?
Okay, well, he says that investment is an operation that's based on thorough analysis.
Thorough analysis. Okay.
Yeah, and the goal is to protect your initial investment,
Yeah.
your principal, and aim for a reasonable rate of return, a good return.
Okay. Makes sense.
But speculation, on the other hand, that's relying more on trying to predict those short-term market swings and hoping to profit from those price movements.
So it's more about timing the market and trying to kind of get in and get out quickly.
Exactly. It's like it's like trying to time the waves when you're surfing. You might catch a few good ones, but you're also likely to wipe out.
It's more risky. So why should I care about this distinction? Like, is a little speculation really that bad?
Well, imagine putting all your hard-earned money into a stock just based on a gut feeling or maybe a hot tip you heard from somebody.
It happens all the time.
Right, and then the market takes an unexpected turn and suddenly your investment plummets.
Oh, yeah, I've been there.
Yeah, and that's why mistaking speculation for investment can be really, really risky. And Wall Street often blurs these lines. They make speculation seem like a sure thing.
Like it's a guarantee.
Exactly, but it's not. And I think Graham's metaphor of Mr. Market really, really illustrates this well.
Yeah, I love that metaphor. Tell us a little bit about Mr. Market.
Okay, so picture Mr. Market as this whimsical character who's always offering to buy or sell your stocks every single day.
Every day. Wow, he's busy.
He is, but here's the thing. He's driven purely by emotions. He's swinging wildly between, euphoria and despair.
So he's not very stable.
Not at all. So the key takeaway here is to not let Mr. Market's mood swings dictate your actions. Don't get swept up in all that.
So it's more about making informed decisions based on solid research and not reacting to every little, up and down in the market.
You got it. The intelligent investor, they recognize that Mr. Market's irrationality can actually present opportunities.
Oh, interesting. So you can use it to your advantage.
Exactly. You have the power to choose, when to engage with Mr. Market and when to just walk away.
That's a really powerful concept.
Yeah.
I like that.
It's all about having that control.
Now, Graham talks about two main types of investors, the defensive investor and the enterprising investor.
Right.
So who are these people?
Well, it depends on your personality, really, your time commitment and how much risk you're comfortable with.
Right. Everyone's different.
Exactly. So
Yep.
the defensive investor, they really prioritize simplicity and safety. They're not looking to spend hours and hours researching companies.
So they're kind of more laid back.
A little bit, yeah. They're probably more likely to opt for a portfolio with a mix of stocks and bonds, maybe some index funds.
Okay. And that sounds like a good approach for somebody who's just getting started with investing, or maybe they don't have a lot of time to devote to it.
Absolutely. It's a great starting point.
Now, what about those enterprising investors? They sound a little more adventurous.
They are. They're the ones who are really willing to roll up their sleeves, dig deep into the research and analysis to try to uncover those undervalued opportunities.
So they're like the real detectives, going the extra mile.
Exactly. They're looking for those hidden gems.
So it's not about one approach being better than the other. It's more about finding the one that really fits your individual needs and goals.
Precisely. Figure out what works best for you and your situation.
All right. So no matter what type of investor you are, Graham emphasizes some core investment principles that can help you navigate the market more effectively.
Oh, absolutely. These are like the golden rules of intelligent investing.
Okay, so lay it on us. What are some of these golden rules?
All right. Well, one of the most important is this concept of margin of safety.
Margin of safety. Okay, I've heard that before, but I'm not sure I fully understand it.
So it basically means buying a stock below its intrinsic value.
Okay, and intrinsic value
It's
is...
basically what the company is truly worth, not just what the market is currently pricing it at.
Oh, okay, so it's kind of like a built-in buffer.
Exactly. You're creating a cushion to protect your investment even if things don't go exactly as planned.
So if you can buy a stock for less than it's worth, then you're already ahead of the game.
Right. And Graham actually offers a real-world example of this with a company called Northern Pipeline.
Oh, I've heard of them.
Yeah, he discovered that their stock was trading below the value of their bond holdings alone.
So the market was undervaluing them.
Yes, and by buying those stocks and then advocating for a dividend increase, he ended up making a significant profit.
Wow, so it's not just about buying low and selling high. It's about buying when the price is significantly lower than the real value of the company.
That's the key, and that's why being a financial detective is so important. You need to carefully analyze the evidence. The company's financials, its management, its competitive landscape, all of that to determine its true worth.
So you're not just throwing darts at a board.
No, you're making calculated decisions.
What other principles should we keep in mind?
Well, another really important one is to focus on the long term. Avoid getting caught up in that short-term noise and hype that can drive the market crazy.
Because the market can be pretty emotional.
It can. And remember, Graham wrote this book after living through the Great Depression, so he saw firsthand how fear and greed can lead to really bad decisions.
That makes sense. So it's about not panicking when the market dips and not getting too greedy when it's soaring.
Right, exactly. It's like planting a tree. You don't expect it to grow into a giant oak overnight. You nurture it, you give it time, and eventually you'll bear fruit.
That's a great analogy.
Investing is the same way. It requires patience and discipline to weather those storms and reap those rewards of long-term growth.
And that long-term mindset also helps you avoid making those impulsive decisions based on Mr. Market's mood swings, right?
Absolutely. It's about remembering your goals, sticking to your plan, even when the market is tempting you to stray.
Speaking of temptation, what about dividends? It seems like they've kind of fallen out of favor lately with all the focus on growth stocks.
Yeah, it's true. There's a lot of hype around those high-growth companies, but Graham, he considered dividends to be a tangible return on your investment and a sign of a company's financial health.
So it's like they're sharing their profits with their shareholders.
Exactly. And he saw them as a powerful force in shaping stock policy and shareholder value.
So while growth is important, dividends can provide a steady stream of income and potentially signal that a company is financially stable.
Right. And remember, Graham was writing this long before the rise of index funds and ETFs. So for investors back then, dividends were an even more crucial part of their overall return.
Okay, this is all incredibly helpful, but let's get down to brass tacks here. What are some specific strategies that Graham recommends for putting these principles into action?
Right. So he offers different approaches for defensive and enterprising investors, depending on their risk tolerance.
So tailor-made advice.
Right. For those seeking a more passive approach, he suggests dollar cost averaging into index funds.
Dollar cost averaging, explain that one.
Sure. So it means investing a fixed amount of money at regular intervals.
Okay, so like every month or every paycheck.
Exactly. And you do this regardless of what the market's doing.
So you're not trying to time the market.
Exactly. You're taking the emotion out of it and building your position gradually over time.
That sounds pretty smart, actually.
It's a good strategy, especially for beginners.
Now, what about bonds? Where do they fit into all of this?
Well, Graham recommends allocating a portion of your portfolio to bonds, and the percentage you choose depends on your risk tolerance and also your tax considerations.
Oh, right, because bonds can be taxed differently.
Exactly. He actually compares taxable versus tax-free bonds in different scenarios to show how to make the most of your investment based on your individual situation.
So it's like he's creating a personalized roadmap for each investor based on their own needs and goals.
Precisely.
I like that. Now, what about those more active investors, the enterprising investors?
Okay, so for those who are willing to dig a little deeper, Graham suggests exploring what he calls bargain issues.
Bargain issues. Okay, I like the sound of that already.
Yeah, so these are stocks that are trading below their net working capital.
And remind me what net working capital is.
It's basically a company's current assets minus its current liabilities, so it gives you an idea of its short-term financial health.
Okay, so you're looking for companies that have a lot of assets, not a lot of debt.
Exactly. And he actually conducted a study back in 1957 that showed how buying these undervalued stocks this way could lead to significant profits.
So it's like finding those hidden gems that the market has overlooked.
Precisely. And it does require a deeper level of analysis, looking beyond just the stock price to understand the company's financial health and its potential for future growth.
You've got to do your homework.
You do. He also talks about analyzing special situations like mergers and acquisitions where companies might be temporarily undervalued due to specific events.
So like taking advantage of market inefficiencies.
Right. And finally, he talks about evaluating growth stocks carefully, making sure you're not overpaying just based on hype.
So not getting caught up in the next big thing.
Exactly. He was always skeptical of relying solely on projected growth rates for valuing companies.
Makes sense?
He urged investors to consider a company's track record, its management, its competitive landscape, all of that, before jumping on the bandwagon.
So it's all about being a smart and discerning investor, not just following the herd.
Absolutely.
I'm really starting to see why The Intelligent Investor is considered such a timeless classic. Graham's insights are just as relevant today as they were decades ago.
Oh, absolutely.
But it's not just about the principles, is it? It's about the mindset he encourages, the way he challenges us to think about investing.
You hit the nail on the head. He wants us to be skeptical not just of the market, but of those so-called experts who claim to have all the answers.
Like he's saying, don't just take my word for it, do your own homework.
Exactly. He wants us to be independent thinkers.
Mhm.
Develop our own analytical skills so we can navigate the market with confidence.
That's what I love about this deep dive. It's not just about learning what to invest in, but how to think about investing.
That's the key.
And that's a skill that'll serve you well no matter what the market throws your way.
Absolutely. It's a lifelong skill. It is. And The Intelligent Investor is packed with real-world examples that bring his points to life.
Makes it much more interesting to read.
Oh, yeah. Definitely one that really stuck with me was the story of the Foolish Four stock picking formula.
Oh, yeah, that rings a bell. Wasn't that supposed to be like a magic formula for picking winning stocks?
Yeah, it was this simplistic strategy that got really popular in the 90s, and Graham uses it to show the dangers of relying on these kind of shortcuts.
Okay.
It ultimately performed terribly, and it reminds us that there's really no substitute for thorough research and analysis.
So no get-rich-quick schemes.
No.
None whatsoever.
What other case studies stood out to you?
Well, the rise and fall of companies like Texas Instruments and Chrysler, they really highlight the volatility of high-growth companies.
Right, because those can be tempting.
They can skyrocket one minute and then plummet the next. So it's so crucial to understand what's driving that growth and whether it's sustainable.
Yeah, you don't want to get caught up in a bubble.
Right. And the cautionary tale of the AOL-Time Warner merger. That's a classic example of what can happen when you overpay for a hot company.
Yeah, that was a big one.
It was huge, and it reminds us that even the biggest and most respected companies can make mistakes.
So what goes up must come down. Often, yeah. But sometimes it feels like the market defies all logic, especially with things like meme stocks and speculative bubbles.
Right.
So how does Graham's philosophy hold up in those situations?
Yeah, that's a good question.
Well, that's where the importance of independent thinking really comes in,
Okay.
Remember, the intelligent investor doesn't just blindly follow the crowd.
Right, they do their own research.
Exactly. They analyze the situation, they evaluate the risks, and make decisions based on their own judgment, not the hype of the moment.
So they have the confidence to kind of go against the grain, even when everybody else seems to be making money hand over fist.
Precisely. And that ties back to the idea of controlling your emotions. Graham understood that fear and greed, these are the two biggest enemies of the intelligent investor.
Yeah, they can really cloud your judgment.
Absolutely. They can lead us to make impulsive decisions that we later regret.
Especially in today's market. You're bombarded with information 24/7. It's easy to get caught up in the frenzy.
Oh, it is. You're constantly being pulled in different directions.
Yeah, and make decisions based on fear or FOMO.
Right. And that's why Graham emphasizes the importance of patience and discipline.
Okay.
Don't get swept up in the market's emotional roller coaster. Stick to your investment plan and don't let those short-term fluctuations derail your long-term goals.
It's like that classic advice, time in the market is more important than timing the market.
Exactly.
But that's easier said than done. When you see your portfolio dropping and everyone around you is panicking.
Oh, it is. It's definitely easier said than done. But remember, Mr. Market is always trying to tempt you into making those emotional decisions.
Right. He's a tricky one.
He is, but the intelligent investor recognizes this and uses it to their advantage.
So instead of panicking when the market drops, I should see it as an opportunity to buy quality companies at a discount.
Now you're getting it. You're thinking like a true intelligent investor.
Right.
It's about recognizing that market fluctuations are inevitable and using them to your advantage rather than letting them control you.
I'm really starting to see investing in a whole new light. Now it's less about trying to outsmart the market and more about playing the long game,
Right.
being disciplined, making rational decisions based on sound principles.
That's the essence of Graham's philosophy, and it's something that anyone can learn and apply regardless of their background or experience.
It's really empowering.
Yeah.
It makes you realize that you don't need to be a Wall Street wizard to succeed.
Not at all.
You just need to have the right mindset and be willing to put in the work.
That's the key. And speaking of putting in the work, Graham's discussion of financial reporting and analysis, that's a real eye-opener.
Okay, how so?
Well, he delves into how companies can sometimes manipulate their earnings, to make themselves look more profitable than they actually are.
Oh, wow, that's a little scary.
It can be,
Yeah.
yeah, and I wouldn't even know where to begin looking for those kinds of tricks.
Right, like how do you spot that?
Well, it can be daunting, but Graham provides a framework for analyzing financial statements.
Yeah.
He wants investors to understand what lies behind those numbers and how to spot those potential red flags.
So it's not just about looking at the revenue and profit, but digging deeper into the balance sheet, the income statement, the cash flow statement.
Exactly. He wants us to understand the story that those statements are telling, not just the headline numbers.
So it's like learning a new language, but instead of words, it's numbers and financial ratios.
That's a great way to put it. And just like learning any new language, it takes time and practice to become fluent.
Right, practice makes perfect.
Exactly. But once you grasp those basics, you can start to see through those accounting tricks and make more informed decisions.
So you're not just relying on those analyst reports or news headlines.
Right. You can form your own opinions.
I like that.
And that's what Graham is all about, empowering individual investors to take control of their financial destinies.
He doesn't want us to be passive followers?
No, he wants us to be active, engaged, and informed.
I'm starting to see why The Intelligent Investor is considered a must-read for anybody who's serious about investing.
It's a classic.
It's not just a book about picking stocks. It's a philosophy, a way of thinking that can change your entire approach to managing your money.
It really can, and one of the most important aspects of that philosophy is understanding that investing is a long-term game.
Right, not a get-rich-quick scheme.
Exactly. It's about building wealth slowly and steadily over time.
Delaying gratification.
Yes, making smart choices today that will pay off in the future.
But what about those times when the market seems completely irrational? Like when certain stocks just soar to these ridiculous heights, seemingly out of nowhere.
That's when it's even more important to remember Graham's principles. He reminds us that the market can be irrational in the short term, but it will eventually correct itself in the long run. He even goes so far as to say that the intelligent investor should focus on minimizing losses rather than maximizing profits.
That's interesting.
Yeah.
Wouldn't the goal be to make as much money as possible?
Well, it might seem that way, but Graham argues that by focusing on avoiding those big losses, you inherently set yourself up for long-term success.
Okay.
It's about playing defense as much as offense.
So like in sports, a good defense can win you championships, even if your offense isn't always spectacular.
Exactly. It's about protecting your capital first and then letting the gains follow naturally.
That's a really interesting way to think about it. It's not about always chasing those big flashy returns.
Right. It's about being prudent and minimizing that downside risk.
And that's another example of how Graham really emphasizes the psychological aspects of investing just as much as the financial ones.
He understood that human emotions can be our biggest enemy when it comes to managing money.
So it's not just about learning the numbers.
No.
It's about mastering our own minds and avoiding those emotional pitfalls
Exactly.
that can sabotage our success.
And that's where having a clear investment philosophy, like the one Graham lays out in The Intelligent Investor, can be so helpful.
Right. It gives you a framework.
It does. It gives you a framework, a set of principles to guide you a way to stay grounded when the market gets turbulent.
It's like having a compass to navigate those often treacherous waters of Wall Street.
That's a great analogy. And just like a compass, a sound investment philosophy can help you stay on course and reach your destination even when the seas get rough.
So we've talked about, Graham's emphasis on financial analysis, emotional discipline, long-term thinking. What other insights does he offer in terms of building a successful investment strategy?
Well, one area he delves into quite deeply is asset allocation.
Okay, asset allocation. Tell us about that.
So he believes it's crucial to have a well-diversified portfolio that's tailored to your individual risk tolerance, your time horizon, and your financial goals.
That makes sense because diversifying across different asset classes like stocks and bonds can help to mitigate risk.
Exactly. It creates a more balanced portfolio.
So you're not putting all your eggs in one basket.
Right. And he even gives specific advice on asset allocation, like the classic 50-50 split between stocks and bonds, which he suggests as a starting point for the defensive investor.
So that's a good benchmark to keep in mind.
It is, but he also emphasizes that this allocation should be adjusted based on your individual circumstances.
Right, because everybody's different.
Exactly. He recognizes that no two investors are alike, and what works for one person might not work for another.
Right.
He encourages us to consider factors like our age, our income, our financial goals, our risk tolerance, all of that when determining our asset allocation.
It's like he's giving us a customized roadmap for our investment journey rather than a one-size-fits-all solution.
Precisely, and he constantly reminds us that investing is not a one-size-fits-all endeavor.
So find what works for you.
Exactly, and he emphasizes the importance of sticking to that strategy even when the market is tempting you to stray.
Right, don't get distracted.
Exactly. He reminds us that the intelligent investor doesn't get swayed by the latest trends or fads, but stays focused on those fundamentals.
It's like he's telling us to tune out the noise and focus on what really matters.
He is, and he's also reminding us that investing is a continuous learning process.
Always learning.
Always the market's constantly evolving, and so should our understanding of it.
One thing that really struck me about The Intelligent Investor was Graham's emphasis on the importance of understanding financial statements.
Yes, he really dives deep into that.
He does. He really dives deep into how to analyze balance sheets, income statements, cash flow statements.
He does, and he stresses the importance of not just looking at the raw numbers, but understanding what they tell us about a company's financial health, its profitability, its ability to generate cash flow.
So it's like he's giving us a crash course in accounting and financial analysis.
Exactly, so we can see through the smoke and mirrors.
And make informed decisions about where to invest our money.
Precisely. He wants us to be able to evaluate companies based on their fundamentals, not just their stock price or their latest earnings report.
Not just the hype.
Right. He wants us to be able to separate the wheat from the chaff.
Find those truly valuable businesses.
Exactly. And it's interesting how he emphasizes the importance of looking beyond the hype and the headlines and focusing on the underlying value of a company.
Yeah, getting down to the nitty-gritty.
He does, and he provides us with the tools and techniques to do just that. He talks about analyzing a company's competitive advantage, its management team, its industry dynamics, its long-term prospects.
It's like he's giving us a checklist for evaluating a company's true worth.
He is, and he reminds us that the intelligent investor is not swayed by emotions or speculation, but by sound analysis and a clear understanding of a company's fundamentals.
So it's about looking for value where others might not see it.
Yes.
And being patient and disciplined enough to wait for that value to be realized.
Right. And it's about recognizing that the market is not always efficient and that there are often opportunities to find undervalued companies that can generate significant returns over time.
One thing that really resonated with me in The Intelligent Investor was Graham's discussion of Mr. Market.
Oh, yes, such a brilliant metaphor.
It's such a brilliant metaphor for understanding how the market works and how to avoid getting caught up in its emotional swings.
It is, he describes Mr. Market as this manic depressive character who shows up at your door every day offering to buy or sell your stocks at wildly fluctuating prices.
And the key, as Graham points out, is to not let Mr. Market's moods dictate your decisions.
Right. You have the power to ignore him or even to use his irrationality to your advantage.
So you're not letting your emotions get the best of you.
Exactly. It's about recognizing that the market is often driven by emotions rather than logic, and that the intelligent investor can profit by staying calm and rational when everyone else is losing their heads.
So being a contrarian.
Yes, buying when others are fearful and selling when others are greedy.
And having the discipline to stick to your investment plan.
Yes, even when the market is tempting you to stray.
I love that he gives us this mental framework for dealing with the inevitable ups and downs of the market.
It's so important.
It's like he's saying, don't get swept up in the drama, stick to your plan and you'll be fine.
Exactly. He understood that investing is as much a psychological game as it is a financial one.
So we've covered a lot of ground here, from the importance of distinguishing between investment and speculation to the power of long-term thinking, the need for emotional discipline. Uh, what else can we unpack from this treasure trove of wisdom?
Well, one area we haven't touched on much is Graham's discussion of different types of investors. He talks about the defensive investor who prioritizes safety and simplicity, and the enterprising investor who's willing to put in more time and effort to potentially achieve higher returns.
Right, so different strokes for different folks.
Exactly. And he outlines specific strategies and portfolio allocations for each type of investor. He even talks about the importance of matching your investment approach to your temperament and risk tolerance.
I love how he acknowledges the psychological aspects of investing. How our emotions can influence our decisions,
Absolutely.
and how important it is to be self-aware and choose a strategy that we can stick to even when the market gets turbulent.
He does, and he provides guidance on how to control those emotions, how to avoid getting swept up in market hype, and how to stay focused on the long term.
It's almost like he's giving us a psychological toolkit for navigating the ups and downs of the market.
He is, and he reminds us that the intelligent investor is not ruled by fear or greed, but by logic analysis and a sound investment philosophy.
I'm starting to realize that becoming an intelligent investor is not just about learning a set of rules or strategies, but about developing a certain way of thinking,
Right.
a certain mindset that allows you to approach the market with clarity and confidence.
Exactly. And Graham's book provides a framework for developing that mindset.
Okay.
He challenges us to think critically, to question assumptions, and to make our own decisions based on sound principles, not on emotions or speculation.
And to always remember that investing is a marathon, not a sprint.
Absolutely. It's about patience, discipline, and a commitment to continuous learning.
Always be learning.
Always, the market is constantly evolving, and so should we.
Speaking of journeys, one of the things that fascinated me in The Intelligent Investor was Graham's discussion of special situations.
Oh, yes.
It's like he's inviting us to step into the shoes of a financial detective, looking for those hidden opportunities that others might miss.
It is a bit like that, isn't it?
Yeah.
Special situations involve these unique circumstances where a company might be temporarily undervalued due to specific events.
Okay.
Things like mergers, acquisitions, reorganizations, even bankruptcies.
So these aren't your typical buy and hold investment.
No, they require a deeper level of analysis and a higher tolerance for risk.
They sound a little risky.
They can be. They're not for the faint of heart or the casual investor, but for those who are willing to put in the time and effort to understand the complexities of these situations. They can offer the potential for outsized returns.
So higher risk, higher reward.
Potentially, yes. I remember the example he gave of Northern Pipeline. He saw an opportunity where the market was undervaluing the company's assets. And by advocating for a dividend increase and patiently waiting for the market to recognize the true value, he was able to generate significant profits.
Patience is key.
It's a great illustration of how intelligent analysis and a long-term perspective can pay off in special situations.
So it's a reminder that sometimes the best opportunities are found in those less traveled corners of the market where others might not be looking.
Exactly. But as Graham emphasizes, it's crucial to approach these situations with caution and a clear understanding of the risks involved.
So don't just jump in blindly.
No, he stresses the need for thorough research and careful selection. Not all special situations are created equal, and some can be quite risky.
Right.
He reminds us that even the most promising special situation can go wrong, and having that margin of safety can help to mitigate those risks.
So it's like being a detective, gathering all the evidence and making sure you have a solid case before making a move.
Exactly, and even then, things can still go wrong.
Right, there's always that risk.
But that's part of the excitement of investing, isn't it?
I guess so.
It's about weighing the risks and rewards, making calculated decisions, and being prepared for the unexpected.
So being comfortable with a little uncertainty.
Yes, and having the confidence to navigate those less charted territories where the potential rewards might be higher.
And that's what sets the intelligent investor apart from the speculator.
Right.
They're not just chasing quick profits.
No.
They're looking for long-term value based on solid research, careful analysis, and a deep understanding of the businesses they're investing in.
Exactly.
This whole concept of the intelligent investor is really starting to resonate with me.
Me too.
It's not about having some secret formula or insider information.
No.
It's about developing a certain mindset, a certain approach to investing that allows you to navigate the market with wisdom and confidence.
Exactly. And it's an approach that anyone can learn and apply regardless of their financial background or experience.
So you don't need to be a financial expert
Not at all.
to get started.
It's about empowering yourself to take control of your financial future, to make informed decisions, and to build wealth over time based on sound principles and a long-term perspective.
And that's the essence of Graham's legacy.
It is.
He's not just teaching us how to invest, he's teaching us how to think.
And that's a skill that will serve us well, not just in the financial markets, but in all aspects of our lives.
Absolutely. The Intelligent Investor is more than just an investment guide. It's a guide to life,
I like that.
a roadmap for making smart choices, managing risk, and achieving our goals.
Well said.
We've covered a lot of ground today, from the importance of distinguishing between investment and speculation to the power of long-term thinking, the need for emotional discipline, the value of financial analysis, and even the potential of special situations.
We have covered a lot.
But what does all this mean for our listeners, those intelligent investors in the making?
Right. What's the key takeaway?
I think it means they don't have to rely on, those so-called gurus or hot stock tips to figure things out.
Exactly. They can take control of their own financial future.
Yeah. And achieve those goals without, needing a crystal ball or anything.
It really all comes back to those timeless principles we've been talking about, from the intelligent investor.
Right. The patience, the discipline, doing your own research.
Exactly. Those are the keys to building wealth over time.
And not getting caught up in those, get-rich-quick schemes or thinking that investing is just about gambling.
Right. It's about making informed decisions.
Yeah, using logic and analysis.
Exactly. Not emotion.
And not just jumping on the bandwagon every time you hear a hot stock tip.
No, do your own research.
And remember Graham's concept of intrinsic value.
Yes, that's so important.
It's like a light bulb moment when you realize you don't have to chase the hype. You can find amazing opportunities by, digging a little deeper, understanding a company's true worth.
That's the heart of value investing.
Yeah, and it's something that anyone can learn and apply
Happens
with a little effort and a willingness to think differently. This deep dive has been amazing. It's given me a whole new perspective on investing. But I'm curious, for our listeners out there, what's one investment principle or strategy that really stood out to you?
Yeah, let us know in the comments.
We'd love to hear from you.
And if you're ready to take your investing knowledge to the next level, I highly recommend checking out the full book, The Intelligent Investor.
Yeah, we've only scratched the surface today.
We have, but it's a book you can revisit again and again.
Throughout your investing journey.
Absolutely.
Well, thanks for joining us on this deep dive into intelligent investing.
It's been a pleasure.
Until next time, keep learning, keep growing, and keep diving deep.